Welcome to this financial reporting update. This is one of our series of updates that form part of our Finance Directors seminars. So this is for spring 2024. I'm Stephanie Henshaw. I'm Francis Clark's Head of Audit and Assurance and Technical Partner. And I'll be taking you through today some highlights of financial reporting changes. In fact, after a few quiet editions on the regulatory front, we have suddenly had quite a flurry of action. So I've got a number of things to take you through today. So just to give you a feel for the agenda, first of all, we're going to talk about company size thresholds. Then we're going to talk about changes to FRS 102, and that's something we've trailed for a number of sessions now, but we're finally there. A little bit on supplier finance disclosures and some changes that are coming into force there, and then some other bits and pieces to finish up with. So first of all, thinking about company size thresholds. Now, the size thresholds, small, medium and large, have remained stable for quite a long time now. So we were well overdue a change. And we did telegraph last autumn that the EU were looking at increasing their thresholds by 20%. Now, in fact, the government has recently announced changes to the size thresholds for both companies and LLPs in the UK, and you can see them on the slide here. So broadly, they've gone up by 50%. So at the very bottom of the scale, we've got micro entities where the turnover threshold was 632,000, and that's going to go up to 1 million. For more interest, the small company turnover threshold will go from 10.2 to 15 million, and the total assets threshold from 5.1 to 7.5 million. Medium-sized companies go from 36 to 54 million turnover, and from 18 to 27 million on total assets. Now, obviously, above that threshold, you count as large. One thing you will notice is that the employee criteria have not changed at the moment. They are going to be reviewed later on this year, we understand, but there's no change to those at the moment. Now, these changes will take place for periods beginning on or after the 1st of October this year. We don't have all the details yet. The draft legislation hasn't been published. But we do know that generally to change from small to medium, you need to hit the thresholds for 2 years in a row. Similarly, to change from medium to small, you have to apply 2 out of 3 of the thresholds for 2 years in a row. Usually on transition, they apply the new thresholds to previous years. So you do get the bounce immediately of dropping from one group to another. They haven't published the gross thresholds for groups yet. At the moment, those are approximately 20% higher than the single entity thresholds. And remember, gross here is excluding any intercompany adjustments. If they follow the same pattern, that would suggest the small group limit will move to something like 18 million without stripping out intercompany, and the medium group would be somewhere around 64.5 million. Those are the turnover thresholds. But as I say, we don't know what those are going to be for certain at the moment. So let's just think about some of the headline implications. First of all, starting with audit, small entities in small groups will be exempt from audit. So if you suddenly fall within the small entity or small group threshold, that could leave you off the hook. However, many entities still need an audit for other reasons. So for example, because it's baked into their loan requirements, acquisition agreements, or their articles, or for other reasons their shareholders require them to have an audit. And it's worth saying that those requirements will tend to override what is in the legislation unless those counterparties themselves agree to a change. You will still need an audit if you're part of a medium-sized group, and that includes overseas or UK entities. So even if you suddenly count as small, you won't be off the audit requirement if the group you belong to is much larger than that. And of course, you can still decide to have an audit voluntarily. So you do need to check the position before making plans and making assumptions. Now, if we think about the financial reporting side of things, If you become a small company, having been a medium-sized one, and you're a parent company, a small parent or a parent of a small group does not need to prepare group accounts. And remember, the size of the parent is driven by the size of the group it heads. So if your group becomes small, you become small along with it. If you move from large to medium-sized, then that will exempt you from the requirement to do a Section 172 statement, or indeed a statement under the carbon reporting rules, so the SECR. There is, we understand, going to be a further consultation which may exempt medium companies from other aspects of the strategic report and may simplify some disclosures. And as I mentioned earlier, there is a possibility that that may also increase the employee threshold for a medium-sized company. But we don't know for certain where that is going to land yet. So certainly what we do know is that those changes on the screen there will apply. Now, if we do a bit of a worked example, let's suppose you are an August year end. So your 12 months ending the 31st of August 2024 will apply under the old limits. It's not until August 2025 at the very earliest that the new rules would apply. But actually you have to apply the rules for periods beginning 1st of October. So for an 31st of August 2025 year end, you still won't be eligible under the new rules. You'll have to wait until later. What you can do, however, is that you might want to adopt the rules earlier by adjusting your year end. So, for example, you could extend your accounting period to 30 months to end on the 30th of September. And that would mean that your next accounting period began on the 1st of October 2024. And therefore you would be eligible to use the new limits from September 2025. So it just accelerates where you get access to those. If that results in you qualifying for audit exemption, that could mean one less period needing an audit. But as I mentioned earlier, you'll need to check things like loan agreements and your articles. In terms of extending your year end, you can't extend a period for more than 18 months. And you can't do it more than once in 5 years unless it is to align with a new group basis. So if you've already done an extension in the last 5 years, extending your year end won't work for you, unfortunately. It's also worth making the point, year ends can, or rather reporting dates, can be made up either 7 days either side of your accounting reference date. So moving your reporting date, as long as it's within 7 days of your accounting reference date, may make a difference. If you routinely report on, let's say, the last Sunday of the month, at the moment, if you're reporting at the end of September, that will be Sunday the 29th of September. So you might want to think about moving your reporting date a little bit in order to then think about the impact of the new rules. Main thing is, if you are planning to change your year end in order to try and accelerate access to the changes, please tell your accountant about it. So that's looking at the changes in the legislation. Now let's look at FRS 102. We trailed this in previous sessions, but we weren't quite sure when it would be finalised. So first piece of news, the FRS 102 changes have been published. Now, FRS 102, which is the core of UK GAAP, has a major update every 3 to 5 years. The next major update was published at the end of March. It was largely as we expected and as trailed in these seminars last year. So what we do know is the new version of the standard will be mandatory for periods beginning on or after the 1st of January 2026. And early adoption is permitted. Now, if we take the basic timeline, 2024 is really the year you should do your impact assessment of the new standard. So if you're a December year end, this calendar year would be the time to think about the impact. Next year will be the time to be thinking about your stakeholder engagement and how any changes from the standard might work through into your forecasts. For 2026, that will be the first year you're reporting under the new rules. But of course, 2027 will actually be when you do the accounts preparation and go through the audit process. Although 2026 is the first year you need to be recording differently, the publication of your results on that new basis will come through in 2027, and that's when it will impact on your audit as well. Now, if we look at FRS 102 and the changes, the headlines, the big areas, leases and revenue recognition, both adjusted to align with the relevant international standard with appropriate simplifications. There are two other areas to mention, however. There are expanded disclosures for small companies. So post-Brexit, we're not bound by the limited disclosures in the EU legislation, and the Financial Reporting Council has reinstated some of the requirements that they consider are necessary to give a true and fair view. Now, you won't be reporting under those until 2027, so we're going to leave that to a future session. But it is just worth noting, if you now qualify as a small company with the new threshold changes, that doesn't necessarily mean that you will be able to access all the reduced disclosure that currently exists. You may find that some of those will come back into play. And there are minor amendments as well, quite a number of those sort of consequential amendments in the standard. For this session, we're going to look at the two big areas of change. Now, it's quite high level. The objective really is to give you a starting point for considering the impact on your business. So I thought we'd start with revenue. The revenue chapter in FRS 102 so far has been fairly short and sweet. It gives you some general direction and then it leaves you to get on with it. Now, the new rules are different, and that's not just in the detail, but in how you approach them. Under the new rules, there's a framework, a 5-step model that we have to work through for each kind of revenue in the business. So currently, if you hit a roadblock along the way, you make a common sense call from a range of potential options. In the future, there'll be a right answer. So it will make revenue accounting more consistent, but it could also mean that businesses who've picked an answer that doesn't work under the new model might need to change. So this makes it important to work through the revenue changes sooner rather than later. Now, for many businesses, you'll work through the model and you'll conclude that you don't need to change anything. But for some businesses, you will need to make a change, and you want to know whether you fall into that category or not. The final answer will be straightforward. Each thing we deliver in a contract, each promise is either recognised at a point in time or over a period. But we have to follow this 5-step process through. So let's have a look at how that might work in a particular scenario. And this is just to give you a flavour of the sort of thought process you'll need to go through. So the example we're going to use is software. Now, this is a very simple software version. Very, very well aware that software can create all sorts of challenges. So let's assume we're a business which writes and sells software. For most of our contracts, we install it, we set it up properly, and we provide support for the next year. We also promise we'll continue to update the software over time. So step 1 in the 5-step model is to identify the contract. So let's say our contract is for 2 years, and after that it continues on a rolling basis with 3 months notice. Now, in the past, we'd have made a common sense decision to just look at the 2 years. Now, when we open up the revenue chapter and check the rule, it tells us to just look at the core 2 years, because the rolling period isn't currently enforceable. So it's the same answer, but actually it's more detailed to get there. The second stage is to identify the promises in the contract. Now, this matters with software in particular. Firstly, let's take the installation element. Option 1, it's a fairly typical database setup. Any decent IT support company could do it if they had the installers. So in that case, installation is a distinct promise. Now, option 2, a key part of the installation is configuring the systems so they can talk to each other. The software won't work without it, a third party can't do it, and the configuration wouldn't work within a third party system. So in that case, this is part of the software promise. So if the software ends up being recognised over time, the installation does too. And at this point, we're not making the decision about when to recognise, we're just understanding the promises. Now, the other part of what we do is the updates. If there's a general aim to update the software over time, but no enforceable commitment to do so, that isn't a formal performance obligation, so we just ignore it. But on the other hand, if the software you're providing is designed to make sure that a business is complying with specific regulatory requirements and those changes are coming, so some updates are critical to the continued working of the software, and third parties can't make those changes, then in that situation, the updates will be part of the software promise. And that matters because then they will also need to be recognised over time. So this identifying the promises can get quite granular depending on your business. So sticking with the software example, step 3, what's the total price? Now, often this is straightforward, but actually if the contract contains a service level agreement with penalties for, let's say, slow responses, then your total price will be after deducting the expected or most likely value of the penalties. So if you've historically had a week of downtime every year, you need to take those penalties off your starting revenue on all of your contracts. It also means actually re-estimating your expected penalties over time. So there's some complexity that could apply if you have a service level agreement that has a breach clause in it. Step 4 then is allocation of the price between the promises. And again, there are rules for this. So you take the standalone price of each promise, add them up, and then scale them proportionately to get that total revenue after penalties. Sometimes it's easier said than done. Now, under the current rules, you might make a common sense judgment about how to do it. Under the new rules, there are 2 pages telling us how we do it. And established practice we can refer to from IFRS if that isn't clear enough. So your current approach might not change, but again, you won't know till you work through the detail. Now, step 5 is what we did all this for. When do we recognise each bit of revenue? And this is all about when the customer controls the benefits of the contract. So if the software is a performance obligation by itself and doesn't require critical updates, then the customer may control that as soon as it's up and running and you recognise the revenue up front. If the software can't do its job without critical updates, then it's a combined obligation and therefore you recognise that over time. And that might be evenly, so just on a straight time basis, or there might be some other appropriate measurement to use. If the installation could have been done by anyone, it's a distinct service, it's recognised when it's completed. If the installation is integral to the software, then its recognition will follow what you do with the software. Now, all that was for a pre-existing piece of software being sold to multiple customers. It's a different set of considerations if you're developing software to order. And that might end up with you recognising at creation, or it might not be recognised until you transfer the finished product. The point I'd like to leave you with is you can't just figure it out. You need to check the rules. So our recommendation would be to assess your revenue treatment sooner rather than later, so you know whether it's changing or not. And as I said, for quite a lot of businesses, it won't change because what you're doing actually doesn't have that many variables within it. But there will be some businesses for whom it is more difficult. And we'll be doing more detail on the revenue changes later in the autumn. Now, the other area of change is around leases. The proposal or the intention is to bring all leases on the balance sheet. So for any business that has items held under operating lease, property, vehicles, equipment, the likelihood is you are going to be recognising a right of use asset, which will be a separate category from your other tangible assets, and you'll have a corresponding lease liability. In your profit and loss account, you'll then have a depreciation charge on your right of use asset and interest on the lease liability. Now, the consequences of that in terms of impact on your P&L will neither depreciation nor interest form part of EBITDA, whereas the rental payments on your operating leases do. So you'd expect EBITDA generally to be positively impacted. but the recognition of the lease liability on your balance sheet will impact on your perception of borrowing and change your gearing. So depending on definitions in your covenant documentation, that might impact on the extent to which you meet your covenant tests. But of course, that will also depend what your covenant says on changes to UK GAAP and how the test should be applied. And it'll be different if you're negotiating new covenants later this year and into 2025 that you then expect to be tested on in 2026, because you'll have different accounting rules applying to the ones you're using at the moment. It's also worth noting that if you've got a bonus scheme driven off EBITDA or a share scheme, you might want to reconsider how that works in the light of the changes. After all, should a team get a bigger bonus just because the accounting rules changed how the profit is reported? So an important question to ask ourselves is, what is a lease? Now, there's a definition in the standard. A lease is a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. Now, part of a contract, just note that under IFRS, this is termed an embedded lease. What it means is that we have to recognise there might be wider contractual arrangements that encompass a lease arrangement within them. So a service arrangement that includes payments for specific assets. And that does happen from time to time. So you need to look out for those arrangements. But also, if you've got plant, premises, vehicles, those will fall within the new lease arrangements. So some practicalities. What leases do you have on your balance sheet? Think across the whole business, all the sites you have. Who's got those leases? Plenty of businesses don't have a single repository for all their leases. So do you know the details of yours? Who holds those records? Now, the reason it matters is because there are some practical expedients in the standard. So you don't need to treat as right of use assets short-term leases, things that expire within 12 months, things with a low underlying value. Now, FRS 102 unhelpfully does not put a figure on that, but it does include a list of typical items. So things like mobile phones, printers, computers, which generally fall outside that. We also need to think about how we're going to determine the lease liability and hence the value for the right of use asset. Now, that means you need to work out the present value of the lease payments and you need a discount rate. IFRS says use the incremental borrowing rate, which is often quite tricky to identify. So FRS 102 gives us the alternative of the company's obtainable borrowing rate, which you'd need to get from the bank, but you'd need to refresh it for each new lease you take on. So there are some issues to manage. Now, finally, in the year of transition, how do you get from where you are now to what you'll need to report under the revised version of the standard? Well, when it comes to revenue, you have a choice of restating your prior year or restating your current year opening balances for the effect of a new way of recognising revenue. And it's up to you to choose what you do. But one thing you might want to think about is the comparability of your performance year on year if the new rules significantly change how you recognise revenue. Might it be better to restate your comparatives so that people can compare last year and this year on the same revenue recognition basis? Or are you happy to just have this year's figures under the new basis and restate the opening balance for the impact of any changes? There's definitely some thought to be given to that as to what's the right answer. With leases, if you're a lessee, you're not required to restate your prior year. You keep your opening carrying amounts for your finance leases, and for your things that were previously operating leases, the value at the start of the current year is based on the present value of the future payments at the start of the current year. Now, if you're part of a group and your parent company uses IFRS already, you can use their carrying amounts, and those might be figures you're already reporting for consolidation purposes. For contracts already in progress at the start of the current year, you don't need to reassess whether they contain a lease. So that point I made about embedded leases, in inverted commas, that only applies to new contracts in the first year you apply FRS 102 in its new guise. For fair value changes under the standard, you won't need to restate your prior year valuations, and everywhere else, well, you will restate prior year figures unless there are exemptions, but those are very minor items, so we don't need to worry about those too much. So, just to reiterate, I would encourage you to think about how the timings work. If you're a December year end and typically sign your accounts in June or July, the second half of this year is probably the right time to think about the impact assessment. Is this going to cause major changes to the way you recognise revenue or as regards leases? And that's where I'd work through my revenue approach paper in order to show my conclusion on that. The first half of next year is probably getting the accounts for 2024 prepared and audited. So the second half of 2025 then becomes the point where you think about your stakeholder engagement. What are you going to say to your investors, to your bankers? But also when you're preparing forecasts or budgets for 2026, you want those to reflect the way you'll actually have to account for things in that year. So that's another reason for making sure you've done your homework. Obviously, the first half of 2026, you'll be gathering information under the new rules, but you'll also be getting your accounts for 2025 done, which will be under the existing basis. Second half of 2026 can be where you finalise the impact, and that might be actually where you look at your leases in detail, because that's more of a balance sheet impact. And then we're into 2027 to actually make the changes. So the key things are look at your revenue early and think about the impact of the changes on your forecasts before you get into your 2026 budgeting, so that you know that you're on top of things. Okay, so a couple of other things to pick up. Supplier finance disclosures. Now, this is actually reflected in the new version of FRS 102, but they've given us a slightly earlier application date for this. So supplier finance broadly is where a lender pays your creditors for you and you pay them back with interest, sometimes called reverse factoring, but it's essentially an arrangement for financing. Now, historically, there's been no requirement to say anything about those arrangements in your financial statements. IFRS has introduced a disclosure requirement for December 2024 year ends. So what we've now got is some consistency in the UK. And the disclosure requirements that we will be required to introduce include the key terms and conditions of any supplier finance we got, the carrying amount of the creditor for our supplier finance at the balance sheet date, and payment due dates for our regular trade creditors and our supplier finance obligation. So that's actually highlighting to people the difference it might be making to when you have to settle your debts. Now, the disclosure requirements will apply to periods beginning on or after the 1st of January next year. So it will be December 2025 year ends. So that's 1 year before the rest of the FRS 102 changes bite. Now, finally, let's just pick up some other changes on the way. This is a fairly quick fire round, but we've got some live Companies House changes just to draw to your attention and some incoming ones to flag. So first of all, on the 5th of March, the rules changed regarding registered offices. So registered offices must now meet two requirements. First of all, it must be an address where documents can be served that will be brought to the attention of the people at the company, and also where somebody at the address can sign for receipt of deliveries. So an unattended PO box will definitely fail rule 2. But also, if Companies House tries and fails to make a recorded delivery, they will give you 28 days to give them an appropriate address. And if they don't get one, they will move to strike the company off. So the flag here is just check your current registered office meets those two tests, and therefore you're not going to have any problems. At the same time, they also brought in a requirement for all companies to have a registered email address. Now, like registered offices, documents sent to this address must be capable of being brought to the attention of the people at the company. So if this isn't a specific individual within the company, if it's a a shared email address, it needs to be one which is accessible by several people and which is monitored. Companies House are going to ask for your registered email address as part of your next annual confirmation statement. Now, it's not published, so it's not publicly available, but you will need to provide it. So if you haven't already got something that does the job, you need to think about that. And the third change that came in March is the statement of lawful purpose. So when you incorporate a company and when you do your annual confirmation statement, you will be required to tick a box to confirm your company's intended activities are lawful. Now, I would hope that actually that's not an issue for anybody watching this webinar or attending any of our events, but it is designed to just shine a light on businesses who might be drifting into things where they wouldn't be able, hand on heart, to make that declaration. Now, still in the pipeline with Companies House is the balance of the Economic Crime and Corporate Transparency Act. That includes the failure to prevent fraud, which will be an obligation on large companies. Now, we expect that offence to work in a similar way to the Bribery Act or the more recent criminal corporate offence of facilitating tax evasion. In other words, the defence is to show you took reasonable steps to prevent fraud being perpetrated by the business or by an individual within the business, even if that individual intended the business to develop it by it. We don't know yet what those reasonable activities might be, but obviously the sort of things you do for anti-bribery and anti-tax evasion might be a solid start. Secondly, we know that there are due to be some changes to small company filing requirements, probably requiring the filing of a profit and loss account, but those are not in force yet. And the third one to mention is ID verification for directors and persons of significant control. Now, why do Companies House want to actually require identification? It's largely to prevent scams and development of or setting up of companies with individuals who are not who they claim to be. And the screenshot here is a genuine example from a Companies House case. You would wonder how that one actually got through the system, but it seems that it did. The serious side of this is cloning scams where people target, in this case, hospitality businesses. They set up fake companies, cloning details, or just slightly misspelling names in order to mimic existing businesses. So having an ID verification process for both directors and persons with significant control gives Companies House a little bit more traction on the validity of the people establishing companies. Finally, just thought you would want to be aware that from the 1st of May, some of Companies House fees are rising to cover the administration costs of some of the changes that are being brought in. So particularly pay attention to the online confirmation statements increasing from £13 to £34. You don't want to get caught out without paying the right amount. I hope that's been useful, given you a sense of the changes. I'm just going to come back to this slide around FRS 102 as a reminder. It's periods starting on or after the 1st of January 2026. But don't rest on your laurels and assume that you don't need to take action for another 2 years. As I've outlined, I would strongly recommend you do think about the impact on your business and particularly look at the revenue side of things, just because of those 5 steps you have to go through in quite a controlled way, so that you're able to do your engagement and think about your forecasts before you actually have to apply those new rules. I hope you found that useful. Thank you very much for your time, everybody, and look forward to seeing you on one of our events soon. Thank you.